As of 10:31 a.m. Eastern Time on October 22nd, Opendoor Technologies, trading under the ticker OPEN, is priced at $6.29 per share. That represents a significant intraday drop of $0.67, translating to a painful 9.63% decline for shareholders today. Now, on the surface, this looks like another rough day for a high-growth tech stock in a shaky market. The easy explanation is to point at broader market fears or anxiety in the housing sector. But that's not the whole story. The ferocity of this morning's sell-off, which saw the stock gap down at the open and slice through several technical support levels with conviction, suggests something more specific is at play than just general market malaise. The real driver here appears to be a major reassessment of the company's ability to navigate what is becoming an increasingly treacherous housing environment, and it seems some very large players are heading for the exits before the music stops. The general belief, the narrative that carried Opendoor to its dizzying post-SPAC highs, was built on a simple yet powerful premise. Technology could finally fix the antiquated, slow, and stressful process of buying and selling a home. Opendoor was the pioneer of iBuying, a model where the company itself would act as the market maker, providing sellers with instant all-cash offers. The expectation was that by using sophisticated data algorithms to price homes accurately and by streamlining the process, Opendoor could capture a massive share of the multi-trillion-dollar residential real estate market. Investors were sold on a vision of scale, efficiency, and a future where selling your house was as easy as trading in a used car. This was supposed to be the Amazon of real estate, a dominant force that would redefine an entire industry for generations to come. However, the reality hitting investors today is a far colder and more complicated one. The dream of a frictionless, tech-driven real estate machine is colliding with the hard, messy truth of the physical world. The core of Opendoor's business is not just software. It's buying, holding, and reselling thousands of individual, unique, and highly illiquid assets, houses. This business model is extraordinarily capital-intensive and operates on razor-thin margins. More importantly, its success is almost entirely dependent on a stable or preferably appreciating housing market with high transaction volume. When interest rates rise and the housing market cools, Opendoor isn't just a software company with slowing growth, it becomes a company holding a massive inventory of depreciating assets that are becoming harder and harder to sell. Today's price action is the market waking up to the fact that Opendoor's greatest strength, its ability to buy homes at scale, is also its most profound vulnerability in a downturn. The P/E ratio on the summary is blank for a reason. The company remains unprofitable, and in this economic climate, the path to consistent profitability seems to be getting longer, not shorter. Looking closer at the intraday trading dynamics, the sell-off began before the opening bell. The previous close was $7.96, but the stock opened at $6.74, a significant gap down that indicates a flood of sell orders had accumulated overnight. From there, it was a steady slide to the day's low of $6.28. The volume accompanying this drop has been substantial, well above the daily average, which tells us that this isn't just a few retail investors getting spooked. This has the fingerprints of institutional selling, where large funds may be unwinding their positions due to a change in their fundamental outlook or risk models. When big money decides to get out, they don't do it quietly, and the resulting downward pressure can be relentless, as we are witnessing today. This kind of price action often triggers stop-loss orders from other investors, creating a cascading effect that exacerbates the decline. This downward pressure isn't happening in a vacuum. It's being amplified by a growing cloud of skepticism from short sellers. Recent data indicates that short interest in Opendoor has been climbing steadily, now sitting at a very elevated level, suggesting a significant portion of the market is betting heavily against the company. The short thesis is straightforward and compelling. They argue that Opendoor's pricing algorithms, no matter how sophisticated, cannot predict sharp downturns in local housing markets. They believe the company is at risk of overpaying for homes in a cooling market, leaving it with billions in inventory that it will be forced to sell at a loss. These aren't just theoretical concerns. We saw this play out in previous market wobbles where Opendoor had to take significant write-downs on its inventory, validating the short seller's core argument. Furthermore, the cost to borrow shares of OPEN for the purpose of shorting has been on the rise. This increasing borrow rate is a direct indicator of high demand from short sellers. When it becomes more expensive to bet against a stock, it means the conviction among bears is high. For retail investors, this is a critical piece of information. You can typically find short interest data through your brokerage platform or specialized data providers like Ortex or S3 Partners. Watching metrics like days to cover can also provide insight, A high days-to-cover ratio means it would take a long time for short sellers to buy back all their borrowed shares, which can sometimes create the conditions for a short squeeze if positive news were to emerge. However, chasing a squeeze is incredibly risky. It is far more prudent to understand why the shorts are there in the first place. What's your take on the rising short interest? Smart money sniffing out fundamental weakness, or are they pushing an overly pessimistic narrative? To be clear, Opendoor's business model involves making an instant offer on a homeowner's property, which, if accepted, allows the seller to close quickly without the hassle of showings and negotiations. Opendoor then performs light renovations and aims to resell the home on the open market for a profit. The revenue comes from a service fee, typically around 5%, and any appreciation they can capture on the sale of the home. The problem is that this entire model hinges on speed and accurate pricing. In a market where home prices are falling and properties are sitting on the market for longer, both of those pillars begin to crumble. The company's balance sheet becomes bloated with inventory, and the risk of significant losses grows with each passing day that a home goes unsold. This isn't just a recent phenomenon. A look back at their previous earnings reports reveal a consistent struggle with profitability and cash flow. While the company has shown impressive revenue growth in the past, that growth came at an immense cost. They were buying thousands of homes per quarter, but the gross margins on those sales were often slim and sometimes negative after accounting for all expenses, including interest, repairs, and selling costs. The guidance provided in their last earnings call was likely cautious, reflecting the uncertainty in the housing market, and today's sell-off might be a delayed reaction or a sign that institutional investors believed even that cautious guidance was too optimistic. The macroeconomic backdrop certainly supports this pessimism. With interest rates at multi-year highs, housing affordability is at its lowest point in decades. This freezes the market. Potential sellers don't want to give up their low-rate mortgages, and potential buyers can no longer afford the monthly payments. This reduction in market liquidity is poison for Opendoor's high-volume, quick turnaround model. Looking toward the future, the outlook is sharply divided, a perfect illustration of the tension between expectation and reality. The bull case, the expectation, is that Opendoor is simply navigating a cyclical downturn. Proponents argue that the company is battle-tested, has refined its pricing algorithms, and will emerge stronger when the housing market inevitably recovers. They believe that once interest rates stabilize or decline, transaction volumes will return, and Opendoor, with its brand recognition and operational scale, will be perfectly positioned to capture even a larger share of the market. In this scenario, the current price tag represents a massive buying opportunity for long-term investors who believe in the ultimate vision of disrupting the traditional real estate industry. The bear case, however, is grounded in the current grim reality. The risk is that this housing downturn is not a short, cyclical dip, but a prolonged period of stagnation or decline. In that scenario, Opendoor's cash burn could accelerate as it struggles to sell its inventory without incurring major losses. The company might be forced to raise more capital through debt or equity offerings, which would dilute existing shareholders. There is a non-zero possibility that the iBuying model, as currently constructed, is simply not viable through all phases of a real estate cycle. The shorts are betting that the model is fundamentally broken and that the company will not survive a severe and prolonged housing recession without a radical change to its business or a painful restructuring. Comment below with your price target for Opendoor by the end of next year. Are you siding with the bulls or the bears on this one? The sentiment among retail investors, particularly on platforms like Reddit and X, is a mix of defiance and concern. There is a vocal contingent of long-term holders who are encouraging others to buy the dip, viewing the institutional selling as a panicked overreaction. They argue that the company's long-term potential and argue that the current price does not reflect its disruptive capabilities. On the other hand, a growing number of retail traders are expressing concern over the cash burn and the macroeconomic headwinds, with some even siding with the short sellers and warning of further downside. This makes Opendoor a true battleground stock, where the optimistic vision of the future is in a direct and violent conflict with the pessimistic interpretation of the present. In conclusion, the brutal 9.63% drop in Opendoor's stock today is far more than a simple reaction to market noise. It is a powerful manifestation of the deep-seated conflict between the company's ambitious expectation to digitally transform real estate and the harsh reality of a capital-intensive business model facing severe macroeconomic headwinds. While the bulls see a massive buying opportunity, the bears, backed by significant short interest, see a flawed model teetering on the brink. The ultimate direction of the stock from here will depend entirely on whether the aspirational vision of the company can withstand the brutal realities of the current housing market.